Let's maybe talk a little bit about why financial institutions have credit and debit limits in the first place. What's the purpose of them?
Well, you have to have limits. So
what is a limit? Again?
So a limit,
what's a credit limit and what's a debit?
Right. So when you have an originator, if you are originating debits and or credits for them, you have to assign an amount that they are allowed to originate. So if you have a payroll processor and they only originate credits, then you are going to give them a credit amount, which is the amount that they're allowed to originate on a daily or weekly basis, for instance. So, payroll company ABC is my originator, and I've worked with them. I know that on average, they say that they are going to be originating a daily payroll file of $100,000. So I am going to issue them a $100,000 limit, for instance. I am then required to monitor to that limit utilization. So I am going to make sure that they are staying under that $100,000. If they start originating something more than $100,000, I'm going to have to give them that limit exception so they can physically originate an ACH file that has more than $100,000 worth of transactions in it. Reason being you want to have those limits in place is risk management. So you don't want to give them some astronomical limit, say $500,000 of a limit, if they're only originating $100,000 a day. Reason being is you're going to have $400,000 of risk just sitting out there of where something bad could happen, right? There could be an account compromise. Bad actor comes in, account takeover happens. A payroll file is then issued for $500,000 when they're only going to be on average issuing $100,000. There could be a $500,000 fraudulent file that then goes out at that point. So the more that you're in tune with what your originator is supposed to be originating and you're aligning their limits, the better you are at managing that risk, because you're not only managing that risk for yourself, your financial institution, and that originator, but also out to the network. Because when you're in ACH origination, it's not just all about protecting yourself from the originator. You need to be working on protecting the network and those financial institutions that those payments are going out to.
So go ahead.
Yeah, limits are really this Goldilocks zone. So to Kim's point, right, you don't want to set it too high because then you're overextending credit and you're introducing risk. But you also don't want to set it too low because that's going to have a negative impact on you operationally. Customer needs a $100,000 limit, but you've only set them at $50,000, and now files are constantly getting stopped in the workflow. It's causing operations to have to do these over-limit exceptions. And a lot of the time, right, if an originator has a 5 p.m. cutoff, they're setting that file at 4:45. The more stoppages you have, the more likely you are to miss that cutoff window. You're not getting your file to the Fed on time. It's not getting processed, and you're negatively impacting that customer relationship. So limits really are Goldilocks. You don't want them to be too low to have the negative impact on the customer relationship, and you don't want them to be too high because then you're introducing risk.
Right. So what I hear you both saying is that there's it's a requirement, right? To be in the program, you have originators. Your treasury services, you have originators. You've got to have limits. It's a requirement. But it makes sense to have limits for other reasons, because it manages different aspects of risk that the financial institution has. One would be fraud, to ensure that if someone gets access to an originator's account, they can't send out a lot of credits to accounts they have without there being some check in place. There's operational risk, just making a mistake in the file, duplicating payments. So there's a reason to have a control over that. And there's also there's also a credit risk component to that, because that plays in with a service that financial institutions offer to their originators, where they'll give them the ability to send credits without having money in the account. They call that funding a non-pre-funded versus pre-funded account. So a lot of FIs will, the base case would be, if you want to send credits out, say your payroll, you've got to have money in the account. The FI puts a hold on the funds and then sends the ACH, and that's called pre-funded. The money has to be there. But the liquidity of businesses, many financial institutions, an increasing number, see a customer service benefit and also an economic benefit, because they can generate fee income from the service, of allowing their originators to conduct ACH credits, originate ACH credits, without having to pre-fund, without having the amount in the account, knowing it has to be in there within a certain period of time, or balancing out debits that may come in, knowing that there might not be full liquidity. The financial institution covers that, and there's an economic risk, because if they're not able to reclaim those credits from the originator, they don't put the money in the account, or it doesn't show up there, that could be a very substantial loss. This is like a credit card. So for the financial institution, it's a key tool for credit risk management of FIs to have these limits. So there's a number of different dimensions of risk. Is that fair to say?
Yeah, and that's why it's so important to have accurate limits, to your exact point. So you might say, I need to have pre-funding on any account sending over a certain dollar amount. And some institutions will just have a process in place that says, well, what was their highest single day last year? That's where their limit should be set, rather than looking at what is typical for that originator and setting the limit closer to that value. Because if it's much, significantly lower, maybe they paid out bonus checks once last year at a much higher rate. But if they had a much lower daily average credit, origination rate, they might say like, oh, the risk is significantly less for this customer. They don't need to be pre-funded, and that might be much more attractive to the originator.
Yes, and it is interesting you mentioned that, because I'm looking at our notes from our the study that we did. So we analyzed a number of our clients' activity in terms of how they set limits and how much was actually utilized relative to those limits, because unused utilization represents a risk of breakout fraud. It also represents a credit risk. A lot of times, I spent a number of years in the credit card industry and working for Capital One, and we would track our clients' utilization of their credit card. And what we noticed is there would be clients that had a very low utilization, and then all of a sudden it spiked. It got close to 100%, and then they defaulted, because that's going to be credit that they use when they're in trouble. They can't get liquidity somewhere else. There's a similar anecdote here, and what we found was in our study of our clients at Affirmative, the average utilization. So across the originators that we tracked, the limits, is to give you a sense of the size of the originators and FIs. They range from $250 limit to $90 million limit. So there was an originator with a $90 million limit there. And the average utilization across the board was 33% for the debit limits. We'll talk about debit limits in a minute. It's a similar story related to why you would want to cap debit transactions that your clients put in the system. And then closer to 40% for credit. But that's a huge amount of unused credit limit. And the other risk, so there's the fraud risk component, there's the credit risk dimension. There's also liquidity risk for the financial institution, because if you're not requiring pre-funding for your really good clients that you want to take good care of, and you have to have the money ready to meet those credit needs, that's a lot of cash you have to hold, and you're paying cost of capital on that. You're not generating any income or benefit in terms of client satisfaction or new clients that come to your FI. It's just sitting there as unused utilization. So a lot of our clients have started to pay a lot more attention to tracking their utilization so that they can more actively manage it. And the challenge in doing that is getting the data and getting it organized and having the reporting, and that's what we help them solve. and through our credit and debit limit monitoring. And then one of the things that we're working on for release later this year is an automated credit and debit limit assignment module that tells them, here's the recommended credit limit based on this client's activity.
Yeah, I'm super excited about that. So to Kim's point earlier, a lot of the time the financial institution is making their best guess because they don't have empirical data to base that off of. So what we're aiming to do now is build a recommendation engine based off the client's past activity so you can know for a fact, based on those transaction histories, this is what that client needs in both debits and credits on a monthly basis. And as those patterns change, as their business grows or if they're cyclical or seasonal and those volumes and dollars ramp up and down, we'll be able to tell you, okay, for December, this is the limit that needs to be for that client. And then you can compare it to the limit they have set. Those that are significantly higher can be raised. Those that are significantly lower can be safely be lowered. And you'll know going into the month, exactly where your risk lies and who needs to have a review performed.
Yeah. And we noticed, I think the other thing we noticed was even though there's an enormous gap and unused limit, there was still the tracking, it wasn't tailored enough over time because there was still, I think, 10% of our clients, originators required limit reviews because it stops everything. Someone's got to log in and look at it, probably at 5 o'clock in the afternoon. It's not automated, and it's not based on the natural ebbs and flows of their activity. And that's where we can help clients get a lot better at what they do.
And one real interesting point from that case study was the bank who best aligned their limits with their customers' actual activity had one of the lowest overages rates. So they were best at controlling their limits based on the customer's needs and had the fewest operational stoppages.
Interesting. Yeah, it was, I'm looking here, 7% of the originators across all of our FIs violated their limits at least once during the month of analysis that we did. And, that is an operation that requires time and it's an operational issue. Let's talk a little bit about debit limits because I just want to cover the base. We talked about credit limits. There's the reasons why FIs would have that. There's the credit risk. There's the fraud risk. There's the operational risk. It's actually probably more acute or necessary on the debit side. You guys want to talk about the nature of debit limits and how they work and why they're important?
Sure. So when a financial institution is setting a debit limit, right? So they're sending transactions out to collect funds, which they're then going to have an offsetting credit to pay the originator for that business. That debit limit's in place to control the amount of risk based on that, what they feel their safety of those debit originations are, that they're going to be able to advance funds to that originator for. And there's a couple of different ways they can control for that. They could control for that through having account reserves, or they could control through that through a settlement window saying, I'm going to offer you immediate funds availability or delayed funds availability based on what we assess the riskiness of those transactions are. And that is what that debit limit's in place to control is at any given time, what's that liability for that payment to that originator.
Because there's an exposure if to the extent the FI doesn't hold the funds and to ensure that there won't be claims against them in terms of unauthorized or NSF. How long does that typically take, that cycle? It's like a month?
So it depends on the type of transaction. An account closure or an NSF transaction is typically 2-3 days turnaround time. But an unauthorized transaction, yes, it's when the account holder notices and reports the transaction. And correct me if I'm wrong, but I think that can be up to 180 days from the time of origination.
There's a long tail associated with that. And the extent to which the FI gives their, which they would need, their commercial client wants liquidity. They want access to their funds. And so the FI has to balance how much do I hold in reserve for them versus giving them credit, which would represent an economic risk to me because if there is an unauthorized claim that I can't recoup from the account, then I have to reimburse the RDFI and the account holder. And so there's a risk that has to be managed. So limits are a tool for managing that risk. Fair to say.
Fair to say. I'm sure everyone knows it, but the ODFI, the originating bank, is responsible for all transactions that are originated and any returns that come back. There is no opportunity to not pay that return. So yes, exactly to what you're saying is the financial institution does have to pay out that return regardless. So there's definitely an opportunity for loss there.
One of the things I wanted to add too is with the limit management, a lot of what we experience when we're having conversations with FIs is it's a manual process of changing those limits. So if you're needing to do a temporary increase, you've got to remember to go back in and decrease that limit after that file has gone out. So it's even more important that if you are making temporary increases from a risk management perspective, you got to remember to go back in there and decrease those limits, or you've got to have some sort of visibility of what those daily limit fluctuations are, because a lot of times, just depending on the setup of your department or the system that you're managing those limits in, one person just may be able to go in and up that limit. It may not be a dual control process. So I would hope it would be a dual control process, but sometimes it might not be.
Interesting.
And if you don't remember to go in and lower that limit, or, Susie over in Treasury Management gets busy, right? There's a fire somewhere, has to go be dealt with. She forgets to lower that limit, and then she's on vacation the rest of the week. There's that additional exposure out there. And that's one of the things that I just see. It's so scary within the industry because it's so easy for things like that to happen. And just it creates that additional risk that's absolutely unnecessary because of lack of visibility on some of this stuff. And it's really, really scary with some of the manual processes that are still being used and are still in play with some of this stuff, when really it can be mitigated.
Yeah. So we've talked about in the first part we've talked about the core ACH risk management challenge. We dove into credit and debit limits, which are a very important feature of risk management. It's a critical tool, a necessary, and then hopefully we've demonstrated also a critical tool for Treasury Services departments to be able to manage effectively. And just to wrap that up, like, how do we make it easy for them in terms of our reporting?
Sure. So we do automated limit reporting, and we can help in a couple of facets. During the annual review process, most every financial institution looks at both the originator's usage and how that usage compares against that limit. We make that highly visible and easy for a relationship manager to visualize, see, and understand, exactly where that limit and usage fall. And then we also provide automated reporting across the entire program to say, here is your full list of originators, what their limits are set to, and then how much of that limit on a daily, weekly, monthly basis are they taking advantage of.